Are you missing out on utilizing valuable tax loss harvesting opportunities each year when you file your taxes? Hi, I'm Doug Ray, President and founder of the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about tax loss harvesting, what it is, what capital gains taxes look like versus ordinary income taxes, and what is this thing called the wash sale rule. Now, below the screen here, you're going to see those like and subscribe buttons that are always there. Go ahead and click on those if you want to catch future episodes of The Vault with Doug, Garrett, and myself. And okay, Doug, let's go ahead and get into this tax loss harvesting. A way to, in a way, profit from the losses that you've had if you sell a stock for a loss.
Yeah, Brice, and you know, for a lot of people, this may be a good year to do that. 2023 was kind of unusual. Yeah, the S&P 500 is up, but it's up because of 7 stocks. We call them the Magnificent Seven. Such stocks as NVIDIA, Microsoft, Apple, those kinds of stocks. The S&P 493, however, is flat to down, and some of the stocks in that 493, which you may own, some of them are down pretty significantly.
Right. Yeah, rough year.
So before I get into what tax loss harvesting is, let me do a quick review on capital gains tax rates in this country and ordinary income tax rates. So long-term capital gains tax rates are based on an asset that you hold for a year or longer, and there's 3 of them. It's either the 0% bracket, 15% bracket, and the 20% bracket. Now, which one of those brackets you fall into depends upon your ordinary income, and I'm not going to get into that. We've got other Vault episodes on taxes and tax brackets. Ordinary income tax brackets, there's 7 of them, and they go up as high as 37.5%. So, and even more if you make enough income to hit the Medicare surcharges. But in the short, here's a situation where you may benefit with tax loss harvesting. Let's assume that you have a stock that you've held longer than a year, so it's a long-term gain in that stock. And let's just make it easy math, $10,000 gain.
Okay.
You sell that stock. Then here at the end of the year, you start looking at your portfolio and you notice, okay, I've got some other stocks in here where I've got losses and I've held them more than a year. So it's got to be long-term gain to long-term loss. So you could take those stocks with the long-term losses up to a total of $10,000, sell those, and that would wash away the tax on that $10,000 gain.
Well, it sounds pretty good. So just to recap on that, I sell a stock that I've had for a while for a $10,000 gain, but I've got another stock that has a $10,000 loss in it. I can go ahead and sell that at the same time and basically not have to report that gain, and I don't have to pay taxes on that $10,000 gain because the two balance off.
Yeah, absolutely.
Okay. Sounds fair.
Now, here's something you got to be careful about. You can only do long-term gain to long-term loss or short-term gain to short-term loss.
Okay. You can't mix the two up.
Yeah, that's exactly right.
Okay.
So I guess, the next question becomes, is it really worth it?
Right.
So let's bring up this graphic on the screen and go over a little case study here.
Okay.
This was done by Charles Schwab. So imagine in a year in which you're in the 35% tax bracket, you had a $20,000 short-term capital gain and a $25,000 short-term capital loss.
Okay.
There's 3 ways here you could benefit. You could fully offset your $20,000 capital gain by saving $7,000 because you're in the 35% tax rate, and then you still have $5,000 of capital losses left over. Well, remember earlier we talked about ordinary taxable income. The IRS will let you only use $3,000 of short-term losses to offset ordinary income tax. So you could take that $3,000, offset ordinary income, And that saves you an additional $1,050 in that 35% bracket. So you have a total tax savings that year of $8,050. Now, here's the thing. There's $2,000 left over.
Right.
That $2,000 you can carry forward into 2024 to do some additional tax loss harvesting.
Okay.
Now, here's an important point about tax loss carryforwards. If you have these on the books, make sure you keep all your records going back to however far you started doing tax loss carryforwards. You know, the IRS basically says you don't have to keep your tax records, 3 years, Brice, 5 years, something like that? But when it's a tax loss carryforward, they could go way back and audit you. So you got to have that information.
I believe it's 5 years, but I keep them for 10 anyway.
Yeah. So personally, yes, I think tax loss harvesting is something every investor ought to do.
I mean, you're just missing out on an opportunity if you don't, right?
Yeah. You know, we always say you need to pay your fair share in taxes, but not a penny more.
Yeah, so the way I'm thinking about it is some people might say, well, you know, if I sold a stock for a gain of $10,000, why on earth would I want to sell another stock for a loss of $10,000 just to make it a wash? Well, I guess the idea is that, well, if you sell it for a $10,000 loss and you really like that stock, wait 30 days, you could buy it right back at presumably essentially the same price that you just sold it for. And if you had not done that, then you'd still be paying tax on all that $10,000 gain that you had on the other stock that you sold for a gain.
Precisely.
All right. Well, it sounds kind of like it might require a little bit more legwork and study on your end, but it could save you thousands of dollars in the meantime.
Exactly.
Okay. All right. Anything else we want to hit on this topic?
I think we covered it pretty well.
All right. Very good. Well, that's going to wrap it up for this episode of The Vault. Again, I'll bring your attention to these like and subscribe buttons that tend to be beneath the screen there. If you want to catch more episodes with Doug Garrett and myself, go ahead and click on those. Otherwise, that's going to wrap it up for this episode. I'm Brice Payne.
I'm Doug Ray.
And this has been The Vault.